I'm going to give you 3 examples of the Fed and Bank of Japan to prove my point. Example 1, Abenomics and the yen's weak era. To really understand how we got here, we need to rewind to 2011. Japan was facing a perfect storm: slow growth, persistent deflation, and a currency that was too strong for its own good. Then came Shinzo Abe, elected as prime minister in late 2012, armed with an aggressive economic revival strategy. The world would come to know it as Abenomics. Abenomics was built on what Abe called the 3 arrows. The first arrow, massive monetary easing from the Bank of Japan. The second, fiscal stimulus through government spending. The third, structural reforms aimed at boosting productivity and long-term growth. But it was that first arrow, monetary easing, that really shook the markets. The Bank of Japan, under Governor Haruhiko Kuroda, pulled out all the stops. They launched unprecedented levels of quantitative easing. They promised to overshoot the 2% inflation target. And in January 2016, they took the radical step of moving interest rates into negative territory. That decision marked a turning point. Borrowing in yen became essentially free, even profitable in real terms for some institutions. Global investors piled in to carry trades, borrowing in yen to invest in higher-yielding assets abroad. And the results? Clear as day on the charts. From late 2012 to mid-2015, USD/JPY surged, rising from around 80 to over 125. It was one of the most powerful bullish moves in recent forex history, driven almost entirely by the monetary divergence between the Fed and the Bank of Japan. The yen wasn't just weak, it was designed to be weak. And for carry traders, that era was golden. But here's the thing, that era is over. Example 2, the Fed's awakening into 022